ahead. There's a tremendous amount of uncertainty right now in the Middle East with the budget bill. Nevertheless, the S&P is still near record highs. So what do you make of the market right now?
Well, I think the market right now, we're starting to see that some of that economic uncertainty as far as trade policy is starting to ease. Inflation is the one sticky thing out there, but I think the market is expecting the Fed to capitulate here, start to lower rates here sooner rather than later. And I think that's what's driving us higher here in the most recent days.
So for investors who are feeling a little bit skittish now that we're near the highs again, how are you advising them? Do you have some kind of a system that you can recommend?
Well, we have two ETFs out there, THIR and THLV. Both are systematic in nature, unemotional, takes that emotion right out of the process. We believe time in the market is critical, but we also believe that active management on the side of that can help dampen drawdown if volatility were to come back.
All right, explain how those two ETFs work respectively. Tell me about your system.
Sure. So those two ETFs, they work almost identically, only different mandates. One is equal weight, low volatility, so it's more of a sector-based approach. The other one, THIR, which is an index rotation, more market cap weighted indexes. And really it works by, we want to be long those asset classes when we're not seeing volatility. But when we see volatility, we want to react to that and start to dampen out some of the risk in the portfolio and get a little bit more conservative.
And both those ETFs are fully invested, however. So what are your thoughts on holding some cash if people are feeling a little bit unnerved by the market right now?
Yeah, look, I think having an ability to unemotionally get a little bit more defensive is going to be important. I think markets have come a long way off the bottom. We could see some additional volatility, but we like to use things like short duration treasuries to maybe get a little bit of yield rather than just sitting and holding cash.
And then how do those ETFs fit into an overall portfolio? If you want to have some cash, those ETFs in there, how do you put it all together?
So we think our ETFs are best utilized as a satellite to your already long-only large cap equity exposure. So if you already have a fully diversified portfolio, you're generally long-only. These are a great satellite to help complement and hopefully provide a better risk-adjusted return in periods of volatility.
And then finally, and they also help your clients, investors, stick to a particular plan, because sometimes when you're at near highs, you're at record lows, that's when people do things against their long-term plan and against their long-term best interest, perhaps.
That is the number one reason why these products are out there. Number one detriment to return is fear and making irrational, emotional decisions. These are meant to be held long only. Let us do the active management on the inside. Hold them as part of your long-term plan, as I said, as a satellite to your large cap equity exposure, and I think you'll have a good experience.
All right, well, thanks for coming on and talking about it.
Thank you so much. I appreciate being here.